In this lesson, you're going to learn about when you use enterprise value to calculate valuation multiples, and then when you use equity value instead to calculate valuation multiples. Now, in the previous lesson, we went over some of the most common multiples: EV over revenue, EV/EBITDA, equity value over free cash flow, and PE and price to book value, for example. One thing we didn't cover is why we actually use enterprise value for this first set and why we use equity value or share prices for this last set right here. And the basic difference between these is that when you use enterprise value, you're looking at something that is capital structure neutral. What I mean by capital structure neutral, I'm just listing it over here on the side, is that you are excluding interest, income, or expense. So you're excluding the effects of cash that is earning the company interest income, and you're also taking out the effects of any debt the company has that is incurring interest expense. Now, if you think about it, enterprise value includes the effect from cash, debt, minority interest, preferred stock. So we're basically taking into account all the investors. So one way to think about this, the way I like to think about this in terms of the interest, income, and expense, is that with a metric like EBIT or EBITDA, we have not yet earned this interest income. We have not yet paid out this interest expense. So the metrics here still allow the other investors to get paid. In other words, when we have EBIT or EBITDA, the debt investors have not yet been paid. And so we're going to use enterprise value in this case to reflect the fact that this income from EBIT or EBITDA is still available. So that's another way to think about this, that the income here, you can actually say revenue or profit is available to all investors. And I think that may be the easiest way to think about this, that when you have a metric like revenue, well, revenue is certainly going to effectively go to the equity shareholders, to the investors, because the revenue will flow down, it'll hit operating income, then it'll ultimately go down to net income, and then the equity investors may get some type of dividend based on that. So it's certainly going to go to the equity investors, but it's also going to flow into the debt investors and preferred stockholders because they will get interest on that. They will earn interest from the company paying out interest expense, and then the preferred stockholders will get a preferred stock dividend, and then that will also be flowing in from the company's revenue. So the revenue is available to all investors in the company. Similarly, EBIT and EBITDA are also available to all investors in the company. Because with these metrics, the debt investors have not yet been paid, the equity investors have not yet been paid, and the preferred stock investors have not yet been paid. We're excluding the interest income and expense, so anything that the company is going to owe in terms of interest expense to debt investors, well, that's going to occur below this line item, below EBIT or below EBITDA. Similarly, preferred stock dividends have not yet been taken into account in these, so we use enterprise value because we want something that's capital structure neutral. With equity value, by contrast, it's the opposite. We are taking into account metrics here that are not capital structure neutral, and we're including interest income and expense, and in this case, the revenue and profit available to only equity investors. So let's just think about the reasoning for this one. So for free cash flow, well, let's go down to the cash flow statement and take a look at this again. So for free cash flow, we start with net income right here. Net income, our interest income and expense have already been deducted, and actually preferred stock dividends have already been deducted from this. So they've already been removed from net income right here, which means that anything that's left over here from cash flow from operations and then subtracting CapEx, that is only going to be available ultimately for the equity investors, because the debt investors, the preferred stock investors, the other investors, everyone except for the equity investors, have already been paid, because to get to net income, we've added in the interest income and we've subtracted the interest expense. The same applies to price to earnings per share. With earnings per share, we're effectively taking net income and dividing to get to earnings per share. Net income, we've already reflected the interest income and expense. Now, price to book value. This one is interesting because this one works a little differently. Instead of looking at something on the income statement or cash flow statement, we're looking at a balance sheet metric. The reason why this logic still applies, though, is if you think about it. If we go to our balance sheet, remember that book value is defined as total assets minus intangible assets, and then we subtract all liabilities. Well, in this case, debt and preferred stock, you see that debt here shows up as a liability. Preferred stock would also show up on this side of the balance sheet. It would show up under the liabilities and shareholders' equity side. Same with minority interest. And the same goes for other obligations like pension obligations, for example. So in this case, for price to book value, effectively we are reflecting the fact that, once again, any type of interest expense here has already been removed or taken out because we're excluding debt from the calculation, we're excluding preferred stock from the calculation, minority interest, because we're subtracting liabilities from assets here. And so that's why for price to book value, we use the company's share price, and effectively we're going back to the company's equity value for these types of multiples. Now, if you get a multiple other than these in interviews, you have to sort of think through it and think about whether or not interest income and interest expense are going to be included in that metric and in that multiple. So let's go through a couple examples here. So I think one interesting example here is to think about unlevered free cash flow versus levered free cash flow. So with unlevered free cash flow, we are essentially adding back the interest expense and then subtracting out net income, and we calculate it in a similar way, but we're taking those out and we're tax adjusting the net income here. So in that case, we're actually going to use enterprise value. With levered free cash flow, by contrast, we use equity value because this one has the effects of interest income and expense included. Now, sometimes you get to more exotic multiples. So, for example, for internet companies, sometimes you look at metrics like unique page views or unique visitors. But if you think about this, if you think about whether we should use enterprise value or equity value here, just think through this for a minute. For an internet company, their revenue is going to derive directly from page views and unique visitors. Revenue will then lead to operating income and then ultimately net income at the bottom of the income statement. So in this case, for unique page views and unique visitors and other metrics like this, these are available to all investors in the company, so we're going to use enterprise value. Because effectively, even the debt and preferred stock investors will be earning money, income, as a result of these page views and unique visitors, because these are going to result in revenue, and then the revenue is going to be the basis from which the debt investors and preferred stock investors, for example, get paid. As another example, if you think about the metric EBITDA, so for this one, once again, we're going to use enterprise value because this is simply before interest income and expense, so it should be pretty obvious here. Even though we're subtracting rent here, that doesn't matter too much because the rental expense is something that's going to affect all the investors in the company once again. If we pay more in rent, then the debt investors will not be able to make as much, the equity investors will not be able to get as high a dividend, and the preferred stock investors will not be able to get as high a dividend either. So the rent expense here affects everyone, and so that's why we use enterprise value with EBITDA as well. Now, in real estate, you have some even more exotic looking multiples. And I'm just going to copy these over a bit so I can make room to show you. With real estate companies and real estate investment trusts, we have multiples like funds from operations and adjusted funds from operations. Now, I go into some detail on these in the handout going along with this, but the basic idea here is that these are similar to earnings per share for a normal company, and you often look at them on a per share basis. So I can just put this in parentheses, per share here. What you do here is you're basically taking the company's net income and then you're adding depreciation, because it's a huge expense, but it's not a cash expense for real estate companies. And then you're also removing gains on sale of properties. So do you use enterprise value or equity value to value real estate companies using these types of multiples and metrics? Going back to the point in the beginning, in this case, you would again use equity value, or share price here, because we're starting from net income. We are taking into account the company's interest income and interest expense. And so even though we're adding back depreciation and gains on sales of property here, it doesn't matter because we're including interest expense and interest income, which means that it depends on the capital structure of the company, which means that we need to be using equity value right here. So those are a few examples of how you think through whether to use equity value or enterprise value for the purpose of valuation multiples. Now, if you look at the handout, I go through a couple examples of this and go into more detail on some of the different multiples and metrics you use in different industries, but that's the basic idea of when you use which one here. If you ever get stuck and you need to think about this in an interview, think about whether the metric that you're presented with is before interest income and expense are factored in, or whether it's after they've been factored in. If it's after interest income and expense have been factored in, use equity value. If it's before interest income and expense, then you use enterprise value. And that's the simplest way to think about this and go through it and reason your way through these questions in the context of interviews. Coming up in the next lesson, we're going to be going into more detail on the topic of interview questions on equity value and enterprise value. And we'll go through a couple examples of common questions and then how to address them and convince the interviewer that you know what you're talking about when it comes to equity value, enterprise value, and valuation multiples.